Have you heard the old cautionary phrase, don't put all your eggs in one basket? The analogy behind this saying is that you shouldn't stake everything on one course of action. If something goes haywire, you're most likely to lose everything. This is meant to be a caution against failure to diversify investments across different asset classes. Carrying all eggs in a single basket is subject to breakage and loss if the basket drops, and this is similar to the assets being lost if some portion of the investment is not allocated to a separate account. The good news is diversification is easy to achieve and important for reducing risks. But how do you do that? In this video, I'm going to share 4 tips for building a diversified portfolio. Beginners, this one is going to be very useful for you. So let's begin. When I say different asset classes, I mean you need a combination of equities, fixed income, real estate, commodities, cash and cash equivalents, and derivatives. This ensures that your overall risk is spread out across more asset classes. Number 1, invest in several stocks across various sectors. One of the quickest ways to diversify your portfolio is to invest in companies operating in all kinds of industries, because ultimately the economic cycle affects every business and respective stocks differently. Some industries are cyclical, where a company's wealth shifts as per the economic cycle of the country. For example, consumer discretionary, financial services, and real estate. Here the demand increases as the economy gets stronger. Similarly, some industries are defensive, where the change in the economic cycle does not impact the business. The right example would be utilities and healthcare. If real estate takes a hit due to government regulations or economic slowdown, all those company shares you have purchased will decline together. To avoid a situation like this, it is therefore essential to spread your investment across industries. But one thing to remember is, though stocks offer the highest returns, they are highly volatile, especially in a cooling economy. So please keep that in mind. Number 2, allocate a portion of your portfolio into fixed income. When diversifying your portfolio, it is important to invest some capital in fixed income assets like bonds. While this will restrict the portfolio's returns, it will also reduce the overall risk profile and volatility. Look to bond ETFs, exchange traded funds, for lower risk returns and to generate a source of income from interest payments. The best performing bond ETF that you can invest in are Nippon ETF Long-Term Gilt, SBI ETF, and offered by LIC MF Nifty ETFs. Number 3, consider investing in mutual funds via systematic investment plans. SIPs are fundamentally designed for volatile markets. They ensure that you allocate a fixed amount every month, regardless of the market conditions. Eventually, you benefit from rupee cost averaging, which means your average purchase price drops and you get a chance to yield considerable gains. SIPs are excellent to diversify your portfolio without the risk of entering the market at the wrong time. Number 4, don't forget about your short-term money. It is very easy to diversify your long-term investments through mutual funds, stocks, and other securities, but don't overlook the importance of earning money on your short-term investments. Most banks offer a variety of short-term investments like CDs, money market accounts, high-yield savings account, and government bonds. Though these securities offer lower rates of return, they can be liquidated quickly. This gives you the flexibility to withdraw money whenever you want. However, ensuring checking the early withdrawal penalties if you think you need those funds prematurely. This brings us to the end of this video. I hope you gain some ideas on how you can diversify your portfolio to gain maximum returns. Before we conclude, let me make one thing clear. When it comes to investments, a one-size-fits-all approach never works. So, see for yourself. Identify your investment goals. Determine your risk tolerance and the time frame for which you want to stay invested. See you in the comment section below. Happy investing.